Hello and welcome to another episode of From No Crypto to No Crypto. This is the Crypto Coach, Blockchain Wayne, with another cryptocurrency podcast. Today's episode brought to us by Blockchain Trading Academy, helping to take blockchain and cryptocurrency trading to the masses. Also brought to us by Cryptocurrent and Newscrypto. So let's jump in. Today's episode, we want to talk about margin trading, future trading, spot trading. What is the difference and what are the risks that are involved? So many times I see beginners jump into different types of trading with the speculation that it's a get-rich-quick scheme or it's a lot easier than it sounds. And some types of trading, like margin trading, futures trading, can have some serious risk involved, and you have to understand the risk and make sure you know what you're doing, or else you could lose a lot more money. So, perfect example. So, spot trading is, I don't want to say it's the safest, but it is safer than the other two types of trading, because unless an asset goes completely to zero, you will never lose everything that you enter a trade with. So in other words, if you buy it, say you buy something at $100 and it drops to $50, you've lost 50% of your trade, but you haven't lost everything. If you enter into a margin trade or a futures trade and you utilize leverage, utilize margin within those, you could potentially lose either everything that you came into the trade with or everything that's in that particular trading account, period, because of margin calls when a trade goes the opposite way. So I'm going to explain a little bit about what those are and why does it matter. So spot trading is very simple. Spot trading basically means I'm going to buy it at a current price. I'm going to sell it at a current price. So there's no math needed. You know what you're entering a trade with. You know what you're exiting a trade with. When you go into margin trading is a method of trading assets using funds provided by a third party. Now, this has happened across multiple markets, forex, stock markets, and typically the funds are provided by a third party entity. And in many cases within cryptocurrency exchanges, the funds are provided by other cryptocurrency holders. So in other words, you could have the option to be on the margin on the side of being the lender, whereas you can loan your crypto, hold it into a margin account on a cryptocurrency exchange and earn a percentage, because those that are doing margin trading are borrowing crypto at a certain time, and then they're paying it back whenever they close out the trade, or the trade could get liquidated, and that allows people to earn interest on their crypto. So that's typically how many cryptocurrency exchanges handle margin trading. So the trader has to commit a percentage of the total order value in margin trading to that trade. So in other words, if I am going to trade, say I want to open a position of $10,000, right? And I want to do a 10x trade. I want to do 10 times the leverage. So in other words, whatever I would normally earn on initial trade, I'll earn 10 times that if the trade is profitable. Then I would need to put forth $1,000, to open that 10x trade of $10,000. And that is kind of like my commitment to the trade. And then there's options to either buy, which means you're going long, or to sell short, which means you're going short. You're betting on the price going down if you go short. If you go long, you're betting on the price go up. So say you're in a 10x trade and you've put in $100. So on a 1% trade, or say you put in 1,000, right? 1% trade, you would have made, made $10, right? So on $1,000, you would have made $10, but it's 10x that. So you've added leverage to that to make it 10 times the profit. Now, also this can work the opposite way, and here's where the risk comes in. It's 10 times. It could be 10 times the loss. So instead of losing $10, if it goes the opposite way, you've lost 100 or whatever that trade is equated to. So it's very important to understand those markets. You have options of your leverage ratio where you could go maybe 2x, 5x, 10x, 50x, and so forth. But with that comes more risk. So if the trade goes the opposite way, and the margin call needed to cover your loss is equal to or more than the position you've opened, then you could get liquidated. Liquidated basically means you've lost everything you've gone into that trade with. Now you also have to pay attention to different types of margin calls? Are you using isolated margin? Isolated margin means you're limited to exposure of what's within that trade. So if you're in a trade with $1,000 and you get liquidated, you've lost the full 1,000. But say you have $5,000 worth of crypto in your account, you only lose what you entered the trade with. If you utilize cross margin, then you could potentially lose what's in that trading account, period, if you let it get liquidated. Now, one of the biggest things to hedge against that is when you're going into a margin trade it would typically tell you the liquidation point. And you have to, what I recommend is setting stops, whether it's a stop limit or stop market order, which will allow you to set in advance a certain amount that you're willing to, say, potentially lose if it drops below your price. So that way, if the price continues to free fall and you're in a long position, then you don't get liquidated. You just close out the trade with a small loss. Or if you're in a short position where you're betting on it going down and the price continues to go up, you set a stop as where you're willing to take a loss, and that can help you with that. But it's good to have that going in, because otherwise it could just be a free fall. So you really need to understand trading. You really need to understand charting. Technical analysis and fundamental analysis can all help you make better decisions. And if you go into trades without that and you're just guessing, like, I feel it's going to do this or I feel it's going to do that, or you only look at one bit of information, you're basically gambling when you use those margin trades, right? And futures trading is just basically buying contracts on speculating on what the price will be at a future date. So perpetual contracts basically pay out, say, every 8 hours, depending on the exchange, some more, some less. And then there's quarterly contracts where you're betting on what the price will be at the end of a particular quarter, right? So every 3 months, what will the price be? You're speculating on it. Are you buying to go long? Or you're selling, are you going short on a position on futures? And when that contract closes out, are you going to be in profit or not, based on what your call was and what the current price of that asset is? Now, futures trading started many years ago in Japan when rice was used as a currency, and that's kind of where it started. Rice was used as a currency, so many farmers and many people want to hedge against any kind of volatile spikes or dips in prices. So they would, basically sell futures contracts, which is agreement to buy it at a certain price in the future. So if the current value was less, they still had to buy it, and you bought a contract to buy it at that price. When it closed out, it's settling a trade at a future date. That's all it is. So when you think about that, when you do a spot trade, you're settling that trade as soon as it executes. Futures trade, you're speculating on the price in the future and whether or not you're going to buy or sell short on that. And those also use margin trades in essence, where you can go, again, 2x, 5x, 10x, 15x, 20x, 100x on a position. And, most futures trades typically are around 15 to 1 ratio, or 15x, as we should say. So as you can see, if you get liquidated in a position, you could lose all your money. There's ways to hedge against that. So my recommendation is to look at spot trading, look at margin trading, look at futures trading, and do your due diligence, right? There are some advantages to margin trading, right? You're able to increase a position. If you are trading and you're in a position where you would normally make a 1% profit and you go 10x on that trade, then you can make a 10% profit. But also understand the basics of trading. You're not going to win every trade. You could have every indicator, every bit of data pointing at one thing, and it could go the opposite way. The goal is to have a strategy in place to where, you basically win more trades than you lose, and you also practice good risk management. Because let's face it, you can win more trades than you lose and still lose money if you're not managing your risk within each trade, to where one trade could completely wipe you out. So it's very important to do that. Trade with stop limits or stop market orders, to where stop limit just says if it hits that price, I'm gonna sell it, right? And say you're margin trading or you're spot trading, and you're in profit, right? The price, you buy an asset on a spot trade, or you go long on an asset on a margin trade, and you end up you're in profit based on that particular time frame, but you're not ready to cash it out yet. What many people do is, what you could do is called stair step up your stop limit or your stop market. And all the difference between those two, stop limit basically says the stop is whenever it hits that certain price, it's going to trigger a limit order set at a different price to execute. So it just activates the order. It doesn't guarantee it's going to execute. A stop market order means when it hits that stop, it's going to sell at that particular market price and allow you to cash out. So stop limits are not also designed to mitigate your losses, but also to preserve profit. And if I'm up 20% on a trade, on a margin trade, so I raise my stop limit up to where it's slightly below that price that it's currently at. If the price does free fall, then it basically automatically executes the trade and allows me to exit the trade with a certain amount of profit preserved, versus if it free fall, then I could wipe out all profit that you earned in that trade. So my suggestion again, if you're going to do it, make sure you study and learn about technical analysis, fundamental analysis. The more you learn, the easier it is to do, but there's always risk. There's always going to be emotion involved. So my other recommendation is to start small or paper trade. Paper trade basically means you're not going to actually enter the trade. You're just going to pretend as if you did, whether you log it digitally on a paper trading site, or you can enter it or on paper, and then put what you would close it at, and when that price executes, see if you would have been a profit, would you have been liquidated, and all those different things to see how you did. Or in some cases, what I did personally was I got into an exchange and I started to dabble around with small amounts, right? I would only put up like 10 or 20 bucks into a trade and play around with different types of margin. You can see how easily the higher your margin. So if you're going 100x on a trade, your liquidation point is very close to the current price. So in cryptocurrency with volatility, even though that asset may be moving up and you go long on it, it could have big dips along that way up that could completely wipe out your trade if you got too much exposure on margin. So sometimes it's best not to go big trade. Yeah, it'd be nice to turn 100x, 1% profit into 100% profit, but it's not always feasible and the right thing to do. So you want to make sure you mitigate those risks. Now, what exchanges can you trade margin or futures on? So the most popular ones, of course, are Binance. Binance has both. KuCoin also has both. Margin trading is also available on Bybit and BitMEX. Now, they all have different levels of exposure. BitMEX has a rumor over the years to be heavily manipulated. You see some different candles that happen on different time frames that clear out positions that you don't normally see on other exchanges. So that's just some known controversy over the years. I've personally used KuCoin, Binance, and Bybit in the past to do some of that trading, and it's just, like I said, it's all about mitigating risk. Sometimes I feel better entering just a regular position, or entering, if you're going to do margin trading, do it with low leverage to where maybe I go 5x, right? So instead of having a 1% profit, I could make a 5% profit because I understand to mitigate the risk that instead, if I lose 1%, I'm actually losing 5% of that trade. So it allows you, and it also keeps your liquidation points far away, and allows you to have room to set for whether it's stop losses or stop limits to mitigate your risk. So futures trading and margin trading can be assets you can use to help build your portfolio and increase profits, but I'd also recommend that you mitigate your risk, start small, just dabble in it a little bit to where you learn enough about it to get in and go more, right? So that is the best advice I can give. The reason I wanted to do this podcast is because I've heard recently or talked to people that don't really know a lot about what they're doing, just jumping into these, I hear I can go 50x or 100x on this platform, so I'm jumping in and I'm trading. And those people, many of them are getting absolutely wrecked when it comes to it because they don't understand how to mitigate their risk. How does the trading actually work? They enter a trade and then poof, the account is gone completely. I've heard it happen way too many times where people have lost their entire account off of margin trading and greed, when they really need to step back, understand the risk, understand how to go in. Now, I'm not saying stay away from it completely, but I am warning you with extreme caution to make sure you know what you're doing. Start small, mitigate your risk, learn how to set those stop limits. When you do it with a little bit, it's going to prepare you for what to do when you start trading with more. And even when you start trading with more, you've got to be cautious because you don't have the same emotion if I'm going to lose $10 entering a trade versus I'm going to lose $100 to $1,000 entering a trade. It's a different set of emotions that could, come in. You got to learn how to manage and control your fear and also manage and control your greed, right? Whenever you're jumping into these trades, a lot of times people are blinded by greed of, okay, I can just jump in and make this amount of money. So, jump in, learn what's going on, be a student, and only invest or trade to the level of your education and knowledge. So if you understand a little bit, either only trade a little bit or only mitigate with a little bit of risk. If you understand it a lot, you can then expand on that. This is a learning journey, whether you're trading this, on spot trading, margin trading, or futures trading. So there's risk with all, and you have to understand the risk. Too many people only focus on the reward when they jump into something. They don't understand the potential risk as well. So that's it for today's episode. Hopefully it was helpful, and we will catch you on the next episode.